We have Julian Brigden, co-founder of Macro Intelligence, two partners, helping us to break down what is going to go on with the US economy and the markets as we enter the post-election season. Julian, thank you for joining. We are now into the second to last trading month of the year. We've got investors who have been hoping to see recovery after the S&P broke at 5-month winning streak. October ended in the red. Tuesday, November 5th, we have the election. How do you see a Trump presidency impacting the markets? How do you see a Harris presidency impacting the markets?
So the first thing I would say, Anne, is thank you very much for having me on the show. The second thing I would say is, gosh, you could have given me an easier topic. I mean, I know the markets have run with this assumption that Trump is going to win, but I think on balance, the numbers look a little in his favor, But I would say I've got lots and lots of friends who are sort of what they would call inside the beltway. So their only job is to look at what goes on within the politics of the DC metro area. And they are saying it's extraordinarily close. So I think it's entirely possible we won't know the results straight away. I think we won't know Congress potentially for much longer. I think that is a risk. Look, the other thing I think is, markets are quite expensive. So I would say, I just came back from a trip where I spoke to a lot of hedge funds and clients around the world. And I would say the following. The assumption is that Trump is obviously good for equities and Harris is probably bad. So I think if we get a Harris victory, I think there is a risk that, to use the expression, you go straight to jail, you don't pass go, you don't collect your $200. And with markets sitting at very heady levels, I think there is a risk that we see equities roll. I think more insidiously, I think that a lot of this sort of stasis that we have in the employment market. So in other words, we've seen the level of employment growth slow quite dramatically, but we aren't seeing layoffs. So we've got this sort of balancing act there too. I think there is a risk that it will tip into and start to see layoffs. If, on the other hand, you get a clear Trump sweep, I think you get quite the opposite. I think you instill some animal spirits. We'll see if equities can run up. What I'm hearing is Trump could act quite quickly in terms of his moves on tariffs. I'm not sure that I see that as a positive. So I'm a little cautious on risk here. I think we've run a very, very long way. We are up to some inordinately high levels, technically, when you start to look at Euro stocks. I'm a little cautious.
Donald Trump tariff strategy, at least in his campaign rhetoric, and that would include a 60% tax on Chinese imports, 20% on imports from other nations. When it comes to the specifics of the impact on inflation and consumers' wallets, Julian, what would you foresee there?
Well, I mean, look, at face value, these are, extraordinarily inflationary policies. I mean, some companies will have to eat some of the costs if they're in very competitive marketplaces, which just means it'll hurt their bottom lines. And you've got to expect that some companies who source an inordinate degree of their product, sort of the Walmarts of the world, who are really very, very dependent on China, could get hit pretty hard. But a lot is going to get passed on to the consumer. I mean, companies have already said this. We will just pass this where we can on to consumers. And we saw how good companies were at passing through price increases during COVID. So this is quite inflationary. I think it complicates the hand and the ability of the Fed to act. And I think that, and to cut, and I think that leaves us in quite a dangerous place. And this is why I think there's an awful lot of uncertainty about this very simplistic, Trump is good for stocks, Harris is bad for stocks. There are lots of nuances in exactly how these policies are going to find themselves, particularly in an economy which is, I would say a late stage economy. It's quite stretched. Employment is quite precariously balanced, right? I think there's a lot that could go wrong. But at face value, these policies are definitely inflationary.
I'm going to come back to RAS and the impact on the deficit. But before I do that, Julian, Let's talk about Vice President Kamala Harris, another presidential candidate, calling for easier access to affordable housing, and her plans to specify tax and down payment assistance for first-time home buyers, in addition to incentives for builders to increase the supply of houses in the US. Let's talk about housing, because rent inflation and the lack of supply has been one of the stickier parts of inflationary control, Julian. So with this specific policy from Vice President Harris, how do you see that impacting the inflation and interest rate story?
So look, I'm never a big believer in government allocating resources. Historically, they've never been the most efficient provider of or allocator of resources. But look, at face value, I mean, theoretically, these things can help. I think, and the issue is that is what it does to interest rates, I think, to a large extent, right? So at face value, I suspect what is going to happen is if she gives a down payment for help, we'll just find that house prices will increase by that amount, right? We saw this exactly during COVID. Government gave an inordinate degree of money to consumers and companies took the whole lot. They just raised their prices accordingly because they had the pricing power. They took the lot. And that's why you saw corporate profits significantly benefit. I think, in the housing market, that's the initial risk. This is a very slow-moving market. You've got to find the building land. It's great to say, we want to build all these houses. I mean, you and I come from the UK. We know that Labour's saying the same thing there. Where are they going to find the land, right? In the areas that they want to, because there are no bits of land for them to buy. So I think, government tries to do the best, but it is not easy in equal markets. So I suspect, look, it might be great for the home building stocks. They've already had an amazingly good run as it is. But I'm not sure that it delivers quite as quickly. And I think when I look at the big thing that could actually free up the housing market would be significantly lower rates, because then you would enable those people who are stuck inside their existing homes, not willing to move because they've got that 2.5% mortgage. They don't want 7 for their new house, so they're just kind of sitting there. If you could get that unlocked, that's when you really start to see some of the problems solved. You get the old people, retiring and going down to Florida and getting rid of the big family house in New Jersey or New York or Massachusetts or whatever, and enabling the family to move in there. But we're not there yet.
Let's talk a little bit about, to go back to former President Trump's campaign and some of his strategies. One area where he said, look, government's going to go in the other direction, we'll have less intervention, is with respect to corporate taxes, possibly going down to 15% of the companies that manufacture it within the United States. So Julian, let's talk about that. Can that incentive help reduce America's reliance on imports, perhaps a different way of trying to get to the tariff outcome and help lower prices in a more constructive way?
Yeah, but it takes years. It takes years out.
Takes years.
Right? I mean, we haven't, look, I mean, we've all seen the issues that some of the hyperscalers have faced in terms of trying to build out their AI infrastructure, right? That they're having to turn to nukes. I've read these stories as well, that when you look at some of the districts where people want to manufacture, in the South, for example, where there's less union presence, there just isn't there isn't the electrical infrastructure and there isn't the road infrastructure for them to do it. So look, I think all of these things are potentially advantageous over the medium to long term. Just don't expect them to be solved this week or next week, and markets move that quickly.
You just touched on an aspect of the labor markets, Julian. For what I'm about to say next, if we try to strip the emotion from it and the political controversy around it, and just try to focus on the labor market impact for just a moment, Donald Trump has called for mass deportations of illegal immigrants from the United States. When you think about the impact that could have on the hospitality sector, on the agricultural sector, what is your perspective on the impact on the economy should that policy go into effect?
Once again, in very similar vein to the tariffs, I mean, it almost certainly will be short-term, quite inflationary, quite destructive in terms of what it does. I think what you'll find is that companies, and this is what the data would suggest, companies will just stop producing. So if you can't get the labor to pick the strawberries, you just won't pick the strawberries. So we won't have them. We'll find, a little bit like we saw during COVID, that, you'll get your hotel room cleaned once a week if you're there for the week, or it may not be available at all because they don't have the people. So I think, in a way, that's a sort of stagflationary-esque response function. It's not a positive one. Now, over the long term, you could say, well, this will spur innovation because companies will be forced to try and to boost productivity and bring technology in to replace people, maybe. But I haven't noticed many robo cleaners when I've gone to hotels recently.
No, the only sort of robo area we've seen actually where it might be visible has been, I think, delivery. ServPro is a business that we've seen a little bit, and there has been automation for businesses who've been able to build from scratch. But in terms of conversion, Julian, to your point, it's been harder to see huge capex projects into changing the installed base. Let's switch gears a bit and talk about what the Fed might do. Fed is set to meet on Thursday, November 6th, about timing, to discuss its next rate decision. Expectations at about a 98% chance for another rate cut.
Yep.
We had a 50 basis point cut last time. That was in September. What do you expect to happen, Julian? What's going to happen in the next Fed meeting?
I think it'll be really boring, and I'm going to say 25.
You think
I think it's a done deal. I think, look, this is a Fed who I think is on a glide path, somewhat irrespective of the data. Let's say, as long as the data is okay. If the data's weak, they'd go faster. But provided the data is okay, which is so far the case, they're on a glide path to sort of 4.5, 4.25. At that point, I think they stop and look. I'm not necessarily a big believer that this is just to strain down into the threes, because they've said very clearly in the past that, in a typical easing cycle, they're easing very aggressively because they raised quite aggressively and something broke. That was the exact language that Chris Waller used last year. Nothing's broken, right? So this is more of a kind of mid-cycle sort of easing adjustment type cycle where they kind of easily wait and look. So I think we get 25, and then I think the jury is a little out, data dependent on what happens with the December cut.
The data's super a bit mixed. We've seen, depending on who you read, ADP versus BLS data. We're not quite sure whether the labor market's going up or it's going down in terms of strength or weakness, depending on what you look on the inflation data. 1 month up, 1 month gliding to where it needs to be, and then got the manufacturing data out. It's all over the place a little bit at the moment, Julian. When do you think things will settle down? Is that going to be a post-election issue? Do you think that it's sort of election agnostic in terms of the macro fundamentals?
No, I think I wish it were election agnostic. I'm very much in the camp that I think, and this is historically what the data bears out, that curing inflation tends to require a recession, if you look back historically. And that's why soft landings, irrespective of the sort of PR pump that central banks like to give themselves. They thought we were going to get a lot of soft landing in 2000. They thought we were going to get a soft landing in 2007, and in both instances, they were wrong. And the problem, Anne, is that typically to reduce inflation requires you, because inflation to a very large extent is driven by services inflation, and service inflation is driven by the labor market. It typically requires you leaning on the labor market. And the problem is that the labor market tends to be a very momentum sensitive indicator. So it's either sort of unemployment is either rising or it's falling, and doesn't really track for all this sort of talk of, we're going to sit here at 4 and change % unemployment and it'll be fine. Well, if you look at the charts and you go back 30, 40, 50, 60, 70 years, don't do that. Rises, falls, rises, falls. So I think it's quite hard to achieve that sort of balancing soft landing. And I think we are precariously balanced. We've seen jobs growth slow quite dramatically. I think the ADP numbers are exaggerating. I think that some of the NFP data has been underplaying it, but I think we're running it quite flat. We're not seeing the layoffs, which is the great news, right? We're not seeing the layoffs. But what will decide that, I suspect, may well be the election, right? We have high rates. Companies are waiting for rates to come down. They're waiting for the uncertainty of the election to get out of the way. But I think the big dichotomy and the big thing that I disagree with markets is this idea that if we get this clean Trump win, everything is good, but we still get all those rate cuts and those companies will still start hiring people again. And I struggle with that. Remember, we're dealing with 4% unemployment. How much further, when we re-accelerate growth, what are we dropping to? 2, 3? And we're not getting any wage price increases in that environment? It's really quite an odd market pricing at the moment now.
Last question for you, Julian. You've referenced layoffs, one sector that saw enormous amounts of layoffs relative to the pace at which they've been hiring beforehand is in big tech. So let's finish off there. Players like Amazon, Meta, and others spending billions on artificial intelligence. There are a lot of eyes on hearing what in this earnings season the outlook for AI-related spending was going to be by these companies. Amazon planning to spend $75 billion in 2025. Meta as high as $40 billion in capex by this year's end. Let's just get your hot take, Julian. Is this rate of spending sustainable if rates start to head upward again? Do you think we're at a point where AI investment is almost rate agnostic?
I think to a degree it is, right? I think, actually if rates stay high, the incentive for companies to try and boost productivity will be really, really high to try and sort of improve the bottom line. So to the extent that companies can, they will. And I think these guys are so cash rich that they don't really care, right? They don't really care. They've got better ratings, certainly, arguably, than the federal government. I know that technically you can't. You rarely get rated better than the sovereign. Yes, I think they will continue with the spending. We'll have to see in a high rate environment, if we slip into recession, whether the utilization of their spending by their end clients comes through quite as quickly as they hoped. I think that's the only big debate, not whether they are going to spend. I think they've decided this is an arms race that they all have to participate in.
Julian Brigden, co-founder of Macro Intelligence 2 Partners. Thank you so much for your time. Please come back. Let's come back after the election and see where you think heads head then.
Yes, let's get some clarity, Anne. Thank you very much.
Thank you, sir. What a pleasure to meet you. Great to join you